All right, so this video is going to be a semi-technical video. It's a follow-up from my last video where I benchmarked my portfolio against some of the competition. So I'm going to go into how I'm actually calculating IRR. It actually is sort of challenging to compare something like investing in a house against a hedge fund. So the key theme for this video on how to do this is keep it simple. The way you keep it simple is you break everything down to cash. Okay, cash in and cash out. And that's it. You need one line item. And if you figure out how to do that, then calculating the two most important metrics in investing is really easy. Those metrics are the internal rate of return and the net present value. So this is going to be technical. It would be for those of you who are interested in kind of just learning a little bit about this. So basically what I did here, so I'm just getting set up here, is for every investment that I did, I basically have some line items for anything related to cash. All right, so I'm just going to talk through this real quick. So the first thing you're going to see for something like a house is going to be an owner's distribution. So this is going to be, um, you know, my rent minus management fees and repairs. Okay, and then my property management company is going to send that to me every month. So that's my distribution. Tax adjustment. So the way this works is right at the end of every year, what's going to happen? I'm either going to owe money on these cash flows or I'm going to get a return, right? And different assets are going to perform differently. So let's say I own land and someone's renting out my land. I'm going to have less of a tax deduction because I can't have depreciation on that land than I would if I have something like a house or an apartment building, right? Because I can have a depreciation deduction on those actual buildings. So we'll see here as I go through this, some years I'm actually still having to pay money on my cash flows because what that means is I'm getting more cash than my depreciation deduction is offsetting and my other deductions are offsetting. So the key takeaway there is, not all real estate is going to give you a tax deduction, right? And it's not a bad thing, right? But it kind of plays into an investment strategy and the total portfolio strategy. Okay, a couple of these. Okay, then obviously my mortgage payment is going to be what I'm subtracting there. So every month if I owe a mortgage, I'm going to subtract that out of my cash. Um, so these three things, okay, are basically what's in my checking account at the end of every month. That's going to be net cash. So that's going to be my distributions, my tax adjustment. So that'll be once a year, and then my mortgage is every month. Aggregate cash is just summing that up. So I can see, at what point I'm cash flow positive based on my cash outflow. Value is going to be either estimated or appraised value, right? Because for something like a house, a lot of the value in a house is going to be in the equity, right? Not in the cash that I get back. And then I'm going to have the mortgage balance, right? So that allows me to get to equity. So basically what the main thing you're going to see here is, you're going to see for each property, the equity over time and the aggregate cash. So those are the big things. And that is going to lead to total accrued value. Okay, so total accrued value is just the equity plus the cash. So if we take a look at one example here of how that's going to work out. So for this house I bought in January, I only went down about 10 grand, right? This was only a $61,000 house in Milan, Tennessee. So at that time, you'll see the equity is basically my down payment, 8,250. Well, why is my total accrued value negative? It's because of all the fees, right? So the day you buy a house, it is a negative investment because it was about $1,700 in fees, right? But then you see over time with this total accrued value, I'm cash flowing, about $400, $400. Or sorry, no, these are negative because I'm not receiving rent yet. So negative cash flow, negative cash flow. Now I'm starting to get rents, right? $100, 150, 150, 150. So you start to see, this negative total accrued value kind of start to increase over time. All right. Sorry about that. Okay, so continuing on here. So then the last thing, the main metric I want to get to is IRR. So I'm just going to talk about like why that has to be a special line item. So like I said, like, here are my metrics. So there's kind of three different examples. So upon acquisition, I want to know just what was my cash outflow, right? That's kind of the first thing you do with an IRR. You want to know your cash outflows and what your cash inflows are. So in that last house example, like I said, I paid about 10 grand for that. So that's going to be what I'm going to have in that IRR line item. That's going to be my acquisition. And then my monthly examples, right, are going to be, like I said, my net cash. So the interesting thing here, if you look at these examples, we can see with some of my properties in some years, I actually have to still pay the IRS some money, right? That would basically mean that there probably weren't many repairs on the house that year. So I still owed money on those cash flows, right? So this would be an example where at the end of the year, I think in 2019, for the cash flows I received from that house for that year, I owed about $300 in taxes on that, right? In other years, right, if there were some repairs or maybe I missed some rents, this would be an example where I actually got about a $70 worth of a tax return because of the deduction. And then the last thing, so kind of the challenging thing, when you're going to benchmark something like a property against a hedge fund is I have to pretend like I'm going to sell the house right now, right? So that's why I need to know the equity. So the way I'm doing that basically is I'm incorporating my cash that's sitting in my escrow account. So right now that's about $800 for one of my properties. My cash in is going to be the equity, right? So I sell the house and it's going to be whatever it's worth minus my mortgage. So call that $60,000. And this here is a real example of the actual house I sold, right? The house I sold back in 2022. So I got 60 grand, right? But what are my fees? So the first one is going to be, I'm just guessing a 20% capital gains fee. That's not always true, but just to be conservative, I'm just including that, right? This goes into kind of the larger portfolio tax strategy. So I didn't actually pay capital gains because I kind of offset these passive properties with my active investing where I take huge deductions. So I don't actually pay taxes on this, but just to be conservative, I did. This was the actual sales fee as well. It was about $1,200. So the takeaway here, just for you guys, a kind of random takeaway is selling to an investor has massive advantages, right? If you're doing the math here, I sold this for, I think it was about worth $150,000, this property. So 1,200 for a fee is way low. This is everything, right? This is the title fee. This is everything that had to happen, right? Because there wasn't a real estate agent involved. So if you're going to go and sell something on the open market, this fee is going to be way higher for you. But so this is an example of why you want to sell to an investor. Okay, then the only kind of other things I want to go through here is this is a little simpler for a syndication, how I think about this. So, your cash in for syndication, you're just going to get distributions, typically quarterly. And then at the end of the year, you're going to get a tax adjustment. So for me, it was a big tax write-off. So what you'll see is, my distributions are about $900 a quarter. And then in year one, I got about a $14,000 worth deduction. So the deduction was like 42,000, right? And then I multiply that by my actual tax rate, which is going to be the federal rate and my state tax in California of about 33%. So that's how I'm translating tax deductions to cash, right? Because like we said at the beginning, you want to translate everything to cash. And then yeah, cash out is basically just the down payment here. So then, the way I'm comparing this against index funds, if you come over here, it actually is pretty simple to calculate something like these. So, I'm using ChatGPT for this, but so it's really easy. What I'll do, I'll go to Yahoo Finance and I'll download whatever time period I'm interested in. So for like Berkshire, I did January 2018 to today. I look for their historical data for the stock and distributions. And what I did is I just copied all that. I went in ChatGPT And I said, if I invested $100,000 on this date, how much money would I have now? And then I gave it the data. It was really good at giving me that information, right? I checked it once or twice and it was always accurate. And then I would take that. So an example, this one, I think it ended up being like 183,000. So then all you do is you come over to do something like that. It's as simple as you put in your cash outflow, 100 grand, and then you come over to the end and you put in whatever it was going to be. And then you just have to make sure you have zeros in here. And that's how you can kind of calculate IRR for something like that. And you just do, it's super easy to do this when you break it down to cash. Like I said, you don't have to do any of this like crazy weird stuff people are doing. Now this is monthly. Okay, so that's like the only nuance because this is in months. So then you multiply it by 12. So that's basically how I'm getting these IRRs for all the benchmarks. Let's get rid of that. Okay. And then yeah, again, for these stocks, I'm estimating the capital gains. The capital gains tax I'm going to pay, just like my real estate assets. So that's how I'm doing it. If you're interested, kind of like some of the interesting things you'll see is like dynamics in real estate here is like here's an example with my multifamily deal. So, I'm paying 50 grand for that investment. My first distribution is about 9 months after that. But the cool thing is I got this big deduction. This is the cash value, right? So that was like a $42,000 deduction. So 14 grand right off the bat, and then making a couple, 800 bucks every quarter, something like that. Now this one, when I did this total value sale, this is highly speculative, right? That's why you'll see in my next video, I'm not going to be doing any more of these. I basically did this one just for the tax write-off, but it still really wasn't worth it. It was okay. I mean, it's hard to complain about a 19% IRR, but I'm not stoked on it. And the reason why is because estimating the value of this is really, really challenging. Whereas something like a house is not that hard, right? I can just look it up. But so this is highly speculative as far as if I sold right now, which I really can't even sell because I'm locked in for another 5 years. So the IRR here is just kind of like a guess, just as kind of a side note. Um, the only other interesting thing to note as far as why the IRR for these two properties are so high, 60 and 35%, is because I was able to refinance both of those. So I refinanced here in 2022, almost when rates were at the bottom. So let's check out this month. So yeah, like my cash distribution was 25 grand, right? Where most of that was the refinance. And then you can see in this same year, this was the new appraised value. You can see my equity dropped, right? And the reason for that is because I got now a much bigger mortgage. So on a refinance, you're going to see a big cash inflow, and then you're going to see your equity drop. So I refinanced both of these properties. You can see got like another 11 grand here. You see my equity dropped about 18 grand, right? And that has to do with like fees and all this different stuff. So, if you look at this, my equity dropped 18 grand. I got 11. So about 7 grand in fees, right? So that's a lot. But guess what? I got a lower rate and I got a lot of cash out. So when rates are low, it's really a win for everyone. It's a win for my mortgage company because they made some cash there, but it's also a win for me. Yeah, I guess the last two things I'll cover is so this aggregate here is really easy. I just summed up the total value for everything and the IRR numbers. So you can see like, I bought a house this year. I made some cash. I bought a house cash this year. You keep going. I refinanced that house in this year. I'm making some cash flows, making cash flows with those properties. What else is interesting? Yeah, this year, I sold a house, so I'm getting a bunch of cash. This year, I refinanced two houses, So big cash inflows in this year. I did another investment this year, so this is kind of just an aggregate of my portfolio, the cash in and cash out. So that's where you get that 33%. The only other thing that's maybe interesting is, so these I didn't actually calculate. I just looked these up. So I looked up Bridgewater, I looked up Realty Mogul, and I looked up CrowdStreet. Now I'm also looking at a lot of other capital groups doing this stuff that have higher IRRs. So I'm going to post more videos on that. But for now, so this is how I calculated the IRRs. If you guys are interested in this stuff, you have questions, or if you want a copy of the sheet, I'm happy to provide it. But hopefully, for any of you other nerds out there, this was at least interesting. So let me know if you have questions.